Okay, so we're well through earnings season, and our guest says it has generally been pretty strong. Let's get more from Philip Petursson, Chief Investment Strategist at IG Wealth Management. Philip, great to see you. Thanks for joining us.
Great to be here.
Just any big theme emerge for you from the earnings report season?
Yeah, the big theme is broad participation. We didn't see it. We didn't see narrow earnings. We saw earnings participation across the board, across the sectors, and it was strong, not only in terms of just absolute earnings, but where those earnings were coming from, and that's revenues. So it's not just cost cutting or margin expansion, it's also increasing revenues, and that's a positive sign as we look forward into 2026.
And you reckon that if we look at the market, the Mag 7, it hasn't all gone their way. They don't top every performance list.
Exactly. In fact, there isn't a single Mag 7 stocks at number one, right? The first one was NVIDIA. We'd have to see where it ended up after, or we'll see where it ends up after today. But as at the end of October, NVIDIA was the 36th or 37th best performer of the year. In the top 100, there were only two stocks. It was NVIDIA and Google. Then you have
two Mag 7 stocks.
Two Mag 7 stocks in the top 100. And then in the next 100, you had three. And then beyond that was a couple others. So it hasn't been a story that it's only the Mag 7 this year. There have been a number of other companies that have performed exceptionally well. It's just the market cap weight has skewed it towards the Mag 7 participation.
Generally, the earnings surprises were around 7% for the broad S&P 500, and like better than expected.
Exactly.
And that's consistent with historic norms.
It is, but then what we also saw were 82% of companies surprised to the upside. So that is higher than historic norms. Historically, you would have about 70% of companies surprised. That has been trending up over the past couple of years as companies have figured out how to work the analysts. But in general, in the last couple of quarters, the earnings surprise have been growing. The consistency of that has been growing, and then the absolute surprise has been growing as well.
We didn't, though, you reckon, as a rule, see big jumps in stocks, though, after upside earnings surprises.
You didn't this quarter, right? A lot of it was priced in. So expectations coming in were for significant beats. But we're looking at this market as not a game of capturing 10 or 20 yards a pass. It's more a game of inches here. So every single time that a company continues to increase its earnings year over year, they will be rewarded over time. And we think the story going forward is going to be one of incremental gains as opposed to big jumps in the market.
So we got a forward PE for the U.S. market, I think it is, of about 23 times. You reckon that's not excessive or hugely excessive compared with history?
Yeah, you have to look at it in the context of the bigger picture. So if you only look at valuation, then yes, it looks high. It's at the top end of the 20-year range for the S&P 500. And we have seen weaker markets following levels like this. But if then you match it to earnings growth, which has been strong. Now we have revenue growth that's strong, profit margins that continue to climb. And then look forward, right? We have the Federal Reserve that's going to continue to cut interest rates, inflation that's going to continue to moderate. That's positive for valuation, not negative.
You think the Fed will have to maybe not again this year, but sometime early in 2026?
Yeah, we have another 4 cuts going between now to the end of September next year. So that'll take the Fed funds rate to 3%. We think that's a reasonable level. If inflation's going to settle in around 2.5% through 2026, we think a reasonable level for the Fed funds rate is going to be about 3%. And so we don't think that the Fed is going to be under pressure to take it to 2%. We think 3% is an appropriate level.
Maybe we could have a look at the U.S. 10-year bond yield. It did spike a few months ago up to around 5%. It's down from that level now. I guess one overhang, though, actually it was quite a few months ago. I guess one overhang here, though, is the U.S. government debt. Although, interestingly, apparently the tariffs are going to help out with that.
Well, the tariffs will be a small part. If you look at the absolute level of the deficit and the overall debt, tariffs will make a tiny dent in it. But then again, if Trump gets his way and starts sending out $2,000 checks to Americans, there goes not only what you've earned out of tariffs, but that's going to increase the deficit spending. So we'll see what the outcome is there. In general, the tariffs are like robbing Peter to pay Paul. I don't think it's a good economic policy, certainly not going to reduce the deficit. But in general, if we look back at the economy is growing well. And
south,
yes,
south of the border.
south of the border.
Yeah,
South of the
okay,
border.
yeah.
We're trending at about 3% growth, and I think that's reasonable. In Canada, you're right, it's going to be a little bit weaker, as the Bank of Canada points out. But all of this together suggests that we are in a good environment. There's low risk of recession. The Fed will have to cut because the labor market has softened, and we're watching that. But we don't think it's headed towards a recessionary type labor market where we would see unemployment spike up north of 5%. We don't think that's in the cards anytime soon.
What about Canada? Are you seeing value in Canada?
We're seeing great value in Canada. That's it. When we think about asset allocation, while we like the U.S., we like Canada even more. We're overweight Canada. And this is where you have to parse out the economic situation over the coming 12 months with the market environment. And the market environment in Canada is actually quite attractive.
Right.
Oil producers are cheap. Gold producers are benefiting from the gains in the price of gold. The banks are reasonably valued and generating strong earnings growth. The core three, that's good for the TSX going forward.
Philip, thank you very much indeed.
Thank you for having me.
Philip Petursson kicking the show off for us there, and he is Chief Investment Strategist at IG Wealth Management.